We bring you news and analysis every day on the Tape Podcast. But now you can get the latest news on demand whenever you want. Subscribe to Bloomberg News Now to get the latest headlines at the click of a button. Get informed on your schedule. You can listen to news and subscribe to Bloomberg News Now on the Bloomberg Business app, Bloomberg.com, plus Apple, Spotify, or anywhere else you get your podcasts. Search Bloomberg News Now and subscribe today.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, so we're here at the Bloomberg Sustainable Business Summit. Part of that is financial inclusion. Let's define what financial inclusion is and how do we measure it. Kara Hugenson joins us, Senior Vice President and Head of Workplace Benefits at Benefits and Protection Principal. Kara, thanks so much for joining us here. We appreciate you coming here to Bloomberg. What is financial inclusion and how do you measure it?
So financial inclusion is about giving more people access to tools, products, services that enable them to ultimately, the goal is achieve financial security. And so making sure that a much broader group than today has access to all that they need in order to make those decisions and achieve financial success. You know, it is partly about measuring the access, the number of people that do have access to those products and services, but then it's also about their degree of comfort and security long term, which is a bit subjective because that's going to look different for everybody. But we have a huge opportunity ahead of us to make sure that just that access is taken care of. Principal created an index called the Global Financial Inclusion Index last year. We just this week released our second edition of that. Okay. And it measures financial inclusion across 42 different markets.
Different markets in terms of countries?
Countries, 42 different countries, and really looks at the role of three pillars in each of those countries: the government, the financial system itself, and the role of employers. And so we can measure each of those pillars by country and then aggregate that to determine kind of relativeness around financial inclusion. One of the things that this year's particular index showed is that those countries that are making the biggest progress in terms of financial inclusion are the ones that are making investments to digitally enable access to products and services. Think mobile banking, real-time payments, those types of solutions, which inherently, because so many of us, and an ever greater percentage every day, have access to those computers we hold in our hands. And so that's a really important component of financial inclusion, the tools at people's fingertips.
So I imagine we were just talking about holistic systems, and this isn't something that you're doing because necessarily you feel sorry for the people who aren't included. It's not about charity, right? I mean, in some senses maybe, but really it should be good for the entire society if you include more people. So do you see a correlation between those markets that are more financially inclusive and say, you know, stronger, more sustainable growth?
Absolutely. So great, astute question. So not only did we develop this index, but beyond that, we compared that index to different indicators of overall economic progress, and there is a strong correlation there. Countries that have greater financial inclusion are more resilient, whether it's resilience to climate change, whether it's resilience to geopolitical risks. They ultimately are more ethical economies, and that leads to happier, more food secure individuals and brighter prospects for the future.
How does the U.S. rank on your index?
So the U.S. actually currently ranks number 4.
4?
We actually dropped a couple of spots from last year's rankings, and there were a variety of factors that went into that, one of which is, just consumer sentiment is an underlying consideration in this research, and consumer sentiment is changing given, all the different factors, whether it's the economy and concerns related to that, politics, the news cycle, all of that feeding into overall consumer sentiment. So
who's number 1?
Yeah.
Singapore is number 1.
No surprise there.
Yes, very strong on all 3 pillars.
So much easier, though. It's almost unfair, right? I mean, it's a much smaller market.
It is, yeah. But there's also been a lot of intentionality around how those 3 different pillars all pull their own weight in order to create a very financially inclusive country.
And they have, I think, it's easier with a centrally controlled economy, right? It's probably more difficult with totally chaotic and broken democracy like we have here in the U.S.
There are definitely different sets of challenges when not all the oars are rowing in the same direction.
What are some of the countries that are, maybe making big gains or maybe have some real challenges in front of them?
I would say back to the comments around, digitally enabling, places like Taiwan and Vietnam are making some pretty significant gains because of the infrastructure investments that they are making to enable their citizens to access financial products and services. And beyond that, it's also the education that goes with the use of those products and services.
Are there any big laggards that surprised you? Any countries that you think should be making more headway?
Not specifically country by country. I think, it's probably not a surprise that developed markets that have more resources to support their citizens generally rank higher on the index, and emerging markets tend to fall lower on the index. But again, the digital component and investing in infrastructure to support digitization is really key, and those countries doing that are making the most progress year over year.
How about for women? I'm not sure if it's just U.S. or just kind of what generally your findings are. Women, do they feel more or less inclusive relative to maybe the general population?
Sure. So the short answer to that is they feel less included. They have less confidence, and their perceptions around money management and investing are different than men. There's recent research that Principal did with Her Money that just reaffirm that. I think there's very few people that would say they wouldn't benefit from additional education and advice, but in particular, women will significantly benefit from that.
Well, here's a good little story. Just from yesterday, I had lunch with my 27-year-old daughter. We spent most of the lunch talking about investing. Like
Good
she
for
would,
you.
and she's got that Marcus savings account, and
She's got a high interest rate there.
yeah, she's got a
5%.
high interest rate there. She was just kind of asking a lot of questions about kind of what to do, and
That's great.
yeah. So I was like, nice.
And she's listening to Dad.
Exactly.
True.
Exactly.
I would
But
say
there's 1 out of 4.
She probably has a head start compared to most other women in the world, though.
Right.
You know.
That is very, very true. And that often is one of the issues, is just this overwhelming feeling of where to start. They may, a lot of people don't have a dad that can talk with them,
Yep.
over a meal to, answer those questions. And if you do a search on whatever your browser of choice is, the amount of information that is at someone's fingertips doesn't make that
Right.
process easier.
All right,
Fire
Kara,
hose.
thanks so much for joining us, Kara. Really appreciate it. Kara Hugenson, she's the Senior Vice President and Head of Workplace Benefits at the firm is Principal, correct?
Correct.
Awesome. So we got it there. So we're just talking about the financial inclusion. They've got a cool index there that kind of measures that. The U.S. is ranked number 4. We got a little work to do there, folks. Let's get out there and get it done. This is Bloomberg.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
We got sun beating down on us, right? Coming through the window here at 731 Lexington Avenue.
We should use it.
We should perfect time.
What a great way
Let's
to
put up
make
a solar
energy.
panel. Let's
Yes.
put up a solar panel. Let's talk solar energy. Abigail Ross Hooper joins us. She's the president and CEO of the Solar Energy Industries Association, SEIA, for the folks in the know. Abigail, thanks for joining us here. Talk to us about solar energy. I gotta think it's a big beneficiary of the looking at the
green transition.
Yeah, the green transition, the Inflation Reduction Act.
Right? We've seen peaks and troughs in terms of investor interest, but I'm sure the amount of panels out there just continues to grow to record after record.
Yeah, I mean, first of all, it is hot right here.
Yes.
Okay,
True.
So let's just have a moment. It's working.
Yes.
Okay, if anyone wondered, the technology works.
The sun works.
The sun works.
Global warming feels real.
It's really real right now. Yeah, it is a pretty exciting time to be in the solar industry. Our projections tell us that this year our industry is going to grow by about 52%, which you were talking about something growing at half. As I was walking up here, we're going to double. Which is an exciting. It's pretty.
We were talking about 30-year treasuries.
Yeah.
Typically a very safe investment.
Yeah.
Has been a bad bet over the last 3 years.
Not so exciting. So solar is going to the installations.
Well, what
52%.
about the backlash that Paul has been talking about? It's become a very political issue. ESG in general, the green transition, obviously. And even though we probably see more solar panels in Texas than anywhere else in the country, you've had, especially those people down south, really pushing back against ESG.
Yeah. So that's why you're never going to hear those letters or those come out of my mouth. But you know what you are going to hear come out of my mouth? Lower prices.
Yep.
Because, yes, it is true that California is the state with the most solar in the country right now.
Okay, so California has more solar than Texas.
Texas and Florida are 2 and 3.
Yep.
And over the course of the next few years, it's really a race for which one's going to be number one. Texas and Florida are not known for their big D politics, right? But what they are known for is wanting the lowest energy prices and competitive energy markets. And so that's really why people are going solar. And when I say people, I shouldn't say people. I should say customers.
Yep.
And customers are utilities.
Yep.
Customers are corporations. And customers are homeowners, right? Apartment owners, warehouse owners, utilities, co-ops, kind of anyone that wants low energy prices, which is pretty much every person and every company in the United States.
Can you talk to us about the efficiency of solar energy versus the other sources and kind of how that, I guess maybe the return on my investment works?
Yeah. So you sort of asked two different questions. Breaking news, you guys, the sun does not shine 24 hours a day, okay? And so if your only source of energy is you unplug from the grid and you do not have any kind of backup power, you're not going to have power 24 hours a day. So you have two choices. You can either not unplug from the grid and rely on your electric distribution utility for the other hours of the day, or you can have a backup battery system, or you can have some combination of those. So we talk about the efficiency or sort of the capacity factor of a solar system being about, somewhere between 20 and 30%. But that's like a known feature. That's not shocking news. In terms of your investment, it's a payback period, right? Yep. And it depends on what your energy prices are. So the payback period in where are we now? New York?
Yep.
Yes.
Your energy prices are a tad bit higher than Wyoming, right? Or than South Dakota. And so your payback period is going to be shorter because your prices are higher than in those places. So it might be 7 years here. It might be more years in a lower cost place. It depends a lot on
7 years is what the payback for, you're talking about, I guess, the average family putting solar on their roof.
If you put solar on your roof, exactly. Lots of factors, but that's around-ish.
But how is solar power viewed versus wind, nuclear, gas?
So interesting. You can't actually put wind usually on your home, and you can't have your personal nuke power, right? So
you can if you live in South Dakota.
True. And you ask the SMR guys, right? They're going to tell you can have your own personal SMR. But solar is unique in that you can have your own, it's scalable in a way that a lot of other technologies are not. But utilities, right? They have a choice of different energy prices or energy technologies. Solar is the number one new energy source in the country, and it has been for the last few years. So utilities that are putting out RFPs for new energy sources.
What are RFPs?
I'm sorry. Requests for proposals.
I see.
So they're saying, hey, we have new load. We have new customers. We have new towns that are being built. We have new subdivisions. We have new electric vehicles. We are retiring some assets. We need new capacity to fuel our system. So we're putting out a request for proposals to build some new electricity. So who's the best option? And they'll get a whole bunch of different proposals. And over they are choosing solar and building solar because it's the lowest price. and it's making the most economic sense for
It
their
also, I
customers.
guess, is easier in places like South Dakota or Texas, right, where there's just so much space.
There's a lot of
right?
space.
You're not going to build a solar farm in Westchester County, for example, because everybody's like right next to each
The good
other.
news is the Princeton campus for Bloomberg has a massive solar arrangement down there.
And
panels everywhere.
So does Denison University's campus.
Nice.
I was
Right?
just looking at it in Granville, Ohio.
Right.
But your version of massive
Oh, yeah,
and
I know.
Texas's version of
Yeah,
massive
that's
are a little different.
you're exactly right.
So do you still see growth in those big, massive solar farms?
Yes. So the massive version in the West is like
Thousands of acres.
thousands of acres.
yeah.
The massive version in
Yeah,
Westchester
it's a couple
is some acres.
All right, Abigail, thanks so much for joining us. Abigail Ross Hooper.
Hopper.
Hopper. I got
That's
the.
okay.
I'm sorry, I had the
That's all right.
typo here. President and CEO of the Solar Energy Industries Association, bringing us up to date here on the powers of solar energy. We're going to have more coming up. This is Bloomberg.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's take the discussion of interest rates over to the world of real estate. We can do that with Selma Hepp, Chief Economist at CoreLogic. She can talk about the Fed, the rates, and the real estate market in general. Selma, thanks so much for joining us. I just popped up on the Bloomberg terminal the bank rate 30-year fixed mortgage, 7.88%. Wow, what does that mean for the residential real estate market?
Yeah, I mean, unfortunately, housing market is really in a low. We're sitting on a bottom in many ways. When you look at home sales activity, we're at the lowest that we've been since at least going back to year 2000. And what's even more sad is that we are lower than we were coming out of the Great Recession for the housing market. And that was a really low period for the housing market. In terms of mortgage activity too, we are at some 40-year low. So we're really sitting at this bottom right now, trying to figure our way out. At least now, in terms of home sales activity, what seems to be a little bit of a saving grace is that we do have a little bit more of cash sales going on. So cash share has been on a rise, and that's a function of baby boomers having more equity in their homes, and also to some extent more investors in the market, particularly smaller investors in the market. Also, international buyers seem to be back, so that's helping market a little bit, but nothing to rave about at this point.
Yeah. It's, I guess we go back and look at the last 30, 40, 50 years. A 7% mortgage market is not the craziest thing. We've seen that many, many times. But I guess the question here, the issue here for a lot of folks is, boy, we moved up in mortgage rates from the really, really quickly, more than doubling, in the space of a year. That shock presumably will take some time for, kind of the market to absorb, I guess.
Yeah, absolutely. I think really for a lot of buyers, it is the shock. I mean, affordability, like I said, is at 40-year low, but there are buyers out there, and there are buyers now even at the 8% rate, first-time buyers, for example. So there are folks out there, they're very interesting, but, something we've talked a lot about before is lack of inventory. So it's not even just the rates at this point, but, high rates are locking in potential sellers. Inventory is at the lowest level we've seen historically. So really, it's a quagmire. We're just, there's nothing. It's something, at least we need to see a lower mortgage rate at some point for something to change.
So, I kind of feel like the next issue that somebody has to get a handle on is, what is the rate, or is there a rate that kind of frees up the market, clears out the market, that would make a would-be seller say, okay, yes, I'm getting out of my 3 or 4% mortgage, but the rates are, 5% or 6%, so it's not that bad. Do you guys in the industry have a feeling like where interest rates have to go down to before we start to see some of these sellers come back into the market?
Yeah, I think if we get back to about 6%, slightly below 6%, I mean, that 5 handle is very magical in many ways. But even at 6%, I mean, if you recall earlier this year when mortgage rates came down to 6.2, 6.3, we had quite a bit of activity in the market, and even more, and even inventory was picking up to some extent at that point. At this point, we're just seeing nothing, So I think it will really help to get rates down to 6%.
Because I guess one of the questions is the new housing market. Give us just a sense of what percent, like how big is the new housing market? Can that deal with some of the demand out there? Where are we, like, new housing as a percentage of total housing in terms of supply?
Right. I mean, it has been increasing, especially now as existing home sales are frozen and inventory is frozen. So new home sales as a share of total sales have been on a rise. Historically, I think we've seen about 11% of sales being new home sales. Now we are closer to 15, 16% of home sales, new home sales contributing to overall sales activity. Now, the issue too at this point is that, with mortgage rates approaching 8%, now that's freezing new home market as well. And on the other hand, new home sales are really concentrated in parts of the country where the inventory issues are not as large. So, it's the other parts of the country that continue to suffer as a result of low inventory and higher mortgage rates.
Yeah, because it seems like here in the greater metro area during the pandemic, we had a great exodus of people for, states like Texas and Florida and some of the other maybe Sunbelt states. Is the supply-demand imbalance even more pronounced in some of those faster growth market, or are the new home builders kind of they're there meeting that demand?
Well, I think they're ramping up. I'm not sure that they're necessarily meeting demand, just simply given how many people are moving to those areas. But they're ramping up, and they are, trying to. And one thing to keep in mind is that it's less restrictive to build in those areas and less costly. So they are, in a sense, providing that more affordable inventory, smaller homes, and all these features that the incoming buyers are looking for. So that is helping the market. But again, I think overall, we're still severely undersupplied. If you look at the existing homes for sale, right? For example, we are now at about 1 million, it depends on a month, but to get in a more balanced market, we would need at least double that, at least 1.8 million.
Wow.
Same thing for new home sales. I mean, new home sales are now below about 700,000. I want to say we would need to at least increase that by 50% to get some relief in terms of pressure on home prices and overall affordability and just better balanced housing market.
All right, Selma, let's say I'm able to stomach the 7 to 8% 30-year fixed mortgage. If I go into my bank or my mortgage broker, can I get a loan here? Can I get a mortgage?
Well, I think so. I mean, I think the lenders are really trying to get buyers in at this point, given just how many have fallen out with higher mortgage rates. It sounds like qualifying incomes are now an issue because of debt to income ratio, given how much higher the mortgage rates are. But I mean, lenders are being innovative. They're trying to find ways to qualify folks. And for example, in the new home market, there's still a lot of home builders and developers that are offering mortgage rate buy-down programs, which is helping with that affordability, at least in first couple of years of home ownership.
All right, Selma, so I guess talk to us about the rental market then. If I decide, I can't really stomach a 7 or 8% mortgage, I got to continue to rent or go out and rent versus buy. What are we seeing in the rental market?
Right. I mean, there's two different stories in the rental market. There is a single-family rental market and there is a multifamily rental market. And we've seen quite a bit of new construction going on in multifamily, on the multifamily side, which is putting pressure lower on rent increases. And in some markets, we have now at this point seen decline in rent, especially in these markets that were really high growth, high rent growth during the pandemic. Think of Austin, Phoenix, Vegas. these really, Miami, for example, these really high growth markets during the pandemic. But on a single family side, we are seeing rents plateau, rent growth at least plateau. And actually the markets where we are seeing a lot of increases in rent or relatively higher increase in rent growth are these Midwest, more affordable, sort of easy as it goes kind of markets. St. Louis, for example, tops our list, so it's different dynamics going on, but people definitely who cannot afford are pivoting to single family rental markets.
Hey, Selma, thanks so much for joining us. Really appreciate it. Selma Hepp, Chief Economist at CoreLogic, talking about the real estate business.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.